All right, episode. I actually got the count wrong on the last episode. This is officially episode 40 of Exit Liquidity. 40 episodes. We have Joey, founder and CEO of DYAD, on the show today. Um, I'll let you explain what DYAD is in a sec. We're gonna jump into basically a whole new primitive for stablecoins. Before we get to that, let's just start with a bit of a background on yourself. From what we know, you started in this space in under a year and a half ago, and have already become a founder. So if you want to dive into your background and give us some more info about yourself, I'd love to hear that.
Yeah, absolutely. So all of my career, basically the last decade, since graduating, I've been focused entirely on hardware. So my background is mechanical engineering and industrial design. All of the projects I worked on, companies I founded, all based on hardware. So audio, tea, coffee, pretty much like just devices for everyday rituals. That's what I've always been interested in. That's what I've always kind of gotten obsessed with. Like, how do you make things more efficient, more interesting? How do you create things and experiences that people want to build part of their routine around? Software was always a very big part of these projects, both on-screen interfaces, apps, definitely telemetry. This was kind of during the whole like IoT narrative, very much a part of that. But software alone never felt substantial enough as the medium that I wanted to exclusively build with. This was also during the move fast and break things era, which just that methodology never really appealed to me. I wanted to make things that were thoroughly considered, crafted, extensively tested, and then once you put it out into the world, it's something that you understand you're not going to be able to change later. And that's fundamental to hardware. To software, it wasn't until I discovered Turing complete blockchains. And that was really the moment where a switch flipped for me, where I realized, okay, now you can have these primitives and build with these primitives that were always so exciting and compelling for me with hardware, which is ownership, scarcity, provenance, the psychological possibility of the user, the owner, building an actual emotional connection with the thing. Now that can exist in a purely software domain. And from that point, again, yeah, like a year and a half, 2 years ago, it was closer to 2 years now, that I really started paying attention to this. It was right at the time when like ohm forks were getting really hot. And I remember going, like, Wonderland was starting to be a thing. And I remember going to the Wonderland GitHub, and like, no disrespect, but it was a total shit show. And I saw like, okay, their TVL is this and their GitHub looks like that. There's some massive disconnect here between like demand for this and excitement around it and like the level that's being put out. And so that's when I started to really think, okay, how can I take sort of everything that I've learned developing hardware products as an engineer, my long-term interest in finance and sort of financial design, what are the opportunities here, and very quickly sort of oriented towards stablecoins.
Joey, what was I did a little bit of stalking as any good podcast host would do, and I
Yeah,
came across Ozma. I'm curious to
yeah,
hear
yeah.
about that because I'm a bit of a coffee snob myself, so I'm
Oh,
wondering
cool.
about that.
Yeah, Osmo, that's the last company, hardware company I did before focusing full time on DYAD. And so Osmo was basically kind of taking years of experience that we developed from audio stuff and applying it to rapid cold brew, basically. So this is so funny. My mind is so in like DeFi dyad space. I'm like unzipping like an archived part of myself that I haven't really accessed in over like 2 years at this point. But this is fun. So basically, the trade-offs with coffee. When you extract coffee, you're extracting basically a range of aromatic volatile compounds, and the combination of aroma and flavor is what makes coffee coffee. Now, with espresso, um, that is such a popular and sort of potentially expressive style. Expressive meaning like the person making the espresso, the roaster, the provenance of the beans. All of these can be really drawn out with the espresso process because it's such a fast process, and you can capture these very volatile compounds that only can really exist because they're so volatile for sometimes just a minute after extraction, definitely 5 minutes. So like if you pull an espresso, you will notice that if you let it sit for a minute, 5 minutes, definitely like 10 minutes, at each of those times, what you taste and what you smell will be very different. And with aroma, it's particularly noticeable because those compounds are really volatile. Similar thing in like the fragrance industry, where perfume will never really smell like smelling a flower. Like there's different ways to very skillfully try to capture that. But because the flower is alive and it's producing compounds that are really volatile, there's no technology right now to like bottle that. Similar thing with espresso. That's why like instant coffee, even the sort of like, what's it called? The frozen Cometeer, which is an interesting company if you're familiar. They do the frozen coffee. That's really impressive, especially compared to like freeze-dried coffee, but it's really hard to capture those compounds. So that's sort of the time aspect of espresso. Now, espresso also, though, uses high heat and pressure, which destroys another class of compounds, and that's why people enjoy cold brew. Cold brew extracts coffee without using heat, so you capture this other class of compounds that are still aromatic and flavorful, and you denature in the presence of heat immediately with something like espresso or pour over. That's why, some people can taste a level of like complexity and smoothness and balance in like a toddy style 24 to 16-hour cold brew. The issue there is the time factor, right? Like to me, cold brew, even if it's smooth and has all these flavors, always tastes kind of stale. Because you lose all those more time-sensitive compounds, or you just can't even extract them in the first place because there's no pressure component. So Osmo, we basically were like, okay, how do we capture both the heat-sensitive and the time-sensitive compounds? And so we just used this process called acoustic cavitation, which is literally, normally an espresso pump is a rotary vane pump, or sometimes it can even be like a pistonic, just like a piston pump, basically. What we used instead is a diaphragm pump, which is electronically identical to a speaker driver. And we drove it at a specific frequency. And what that allowed is to basically create the metaphor going from sound. So when you design a speaker, you're basically, or the kind of speakers I designed, it's like you have the front wave and the back wave. You need to take the back wave and use that to reinforce the low frequency response of the front wave by doing a phase shift transformation, basically, where you're basically using the quarter wave, you're letting it exit at a certain frequency. It's like a bandpass filter to the back wave, and it's normally 180 degrees out of phase. You just rephase it, and it's additive below a certain frequency range of the front wave. What's happening in Osmo is there are micro bubbles in the water and in the ground coffee itself. From the ground coffee, it's the CO2 from the roasting process. In water, there just exists it's not even micro bubbles, it's bubble nuclei, actually. And in the presence of this sort of oscillatory pump, this diaphragm pump, we're feeding it a basically consistent 200 hertz signal via the power that's powering it. It's basically causing these bubble nuclei in both the water and the coffee grounds. And we use just a standard portafilter, but it looks kind of different. If you just Google Osmo coffee, you'll see it. It starts to make these little bubble nuclei, like the walls actually start to oscillate in phase with the pump. And as they oscillate, they start to slightly grow. But it's actually that oscillation of the bubble boundaries. There's like many millions of these inside a single portafilter of coffee. That shear force starts to literally knock the compounds in the coffee beans into the water. So in the presence of this frequency, basically, you get this. It's basically acoustic cavitation. When you think of cavitation, normally you think of like pockmarks on a propeller blade or something, because you have these violent explosions. It's not so much the explosion; it's just literally the shearing of the bubble boundaries against the ground up coffee, and that extracts into the water, and it also creates this crema that's not really an espresso crema. It's a crema by other means, which is just these micro bubbles becoming larger and larger as they oscillate in the presence of this frequency. Because basically what they're trying to do is they're trying to grow towards their normal diameter, basically, that would be they're basically 200 hertz diameter, which is way larger than the entire device. None of them make it that far, but the presence of this oscillation at 200 hertz from the diaphragm pump is causing them to grow, basically. So yeah, that's kind of in a nutshell how Ozma worked. Hopefully that didn't scare a bunch of degens away. I promise we're talking about stablecoins here, but that was a good beginning. Yeah. So Ozma, basically the effect of it is you get this rapidly extracted cold brew espresso sort of hybrid thing that it takes a little bit longer to extract than an espresso, but there's a good transference of espresso skills and espresso. Like, we use a standard 58 millimeter portafilter, tamping, using the distribution tool with the little prongs on it. All of these things Ozma benefits from. So yeah, most of our customers were cafes here in the Bay Area. Chromatic, which I think is the best roaster in the Bay Area, maybe on the West Coast, possibly the US. They were an early adopter. They still make a lot of drinks off their menu from the Ozma. And yeah, that's pretty much, could have stayed with that and grown it. But around that time, when it was sort of starting up, I started to get just obsessed with stablecoin design. And so exited Ozma to private equity and started focusing on DYAD full time.
Yeah, I think that's awesome. I think if the people who got lost in the coffee discussion, I'm a big coffee head as well, so that was interesting to me to see how that works. But I think it highlights how into the nitty-gritty you get on anything you're doing, which I think is why we wanted to kind of have the discussion on DYAD. Before that, you mentioned some of the own forks. I was involved in some of those as well. The show is called Exit Liquidity. If you have any recollection of any time that you may have been Exit Liquidity in your time in crypto.
Oh, for me, yeah. So
Yeah.
my actually first experience with any sort of like actual aping into a DeFi protocol was this kind of obscure one. This was actually before I discovered Wonderland. It was this sort of obscure one on, what was it called? It was this EVM layer on top of Near called like, I can't even remember, something with an A.
Harmony? Aurora.
Not
Aurora.
No, I didn't get rugged that bad. No, it was a something. I'll remember it, but it was this protocol called NEC, NECC, and it was actually, I think, an attempt at a stablecoin protocol. I don't know exactly what the mechanism was, but I heard someone on Twitter like tweeted about it, and I bought the volatile token. And I had to make some weird wallet on this EVM layer to even buy it. And there's like one DEX. There's like I don't know, like 150K of liquidity. I didn't really totally understand what I was doing, but I bought into this token at like 40 USD basically, and it went up to like 1500 in like 4 hours. And I was really like euphoric. I was like, oh shit, like I really figured out this DeFi thing. And then there was some flaw in the protocol where you could go, like, I think that one of the utility was like you could go like super levered long on Near, the Near token. And someone did it, and like they couldn't get liquidated basically. And this wasn't like intentional, like FTX style. It was like a flaw in the contract because they just kind of deployed it and didn't audit it or anything. And so once that was discovered, like it just went to zero. So, I was out, like, I wouldn't say that's necessarily exit liquidity because I don't think it was malicious, but I don't know. I lost like $500 or something, but it was a good like early intro to how fast things move, how janky a lot of the stuff was, and just like in general, like hang out on the Discord, being sort of like, I think that $500 is maybe the best $500 I've ever spent, because I hung out on the Discord. I sort of got a sense of crypto culture, DeFi culture specifically. And I'd say like the cultural aspect of it is maybe close second to the actual like technical side and what the actual opportunity is in terms of replacing a lot of what the current financial system does. The culture is just such a strong part of it, and I think is inseparable from the things that are built and the potential that DeFi has ultimately. So yeah, not exactly like it wasn't a rug. It was just like a sort of quickly designed, sort of yeeted out contract that just had this flaw in it that was basically you could essentially drain it by going balls long and not ever getting liquidated. So yeah,
Yeah.
that also got me thinking about like liquidation design is something that one of the things I always sort of upset about. I'm always coming up with liquidation designs because I think that's one of the fundamental like things in DeFi. So that was the beginning of my sort of liquidation design obsession as well.
And what exactly drew you to stablecoins to begin with?
Yeah.
It
So
seems like a difficult concept to wrap your brain around, like decentralized versions of stablecoins. How did you
yeah,
feel about that?
I think stablecoins undeniably have the strongest PMF of any DeFi product or any crypto product period. And I think it's so clear like what the addressable market is and how tiny a part of that is addressed right now. And I think that they're just one of those fundamental building blocks that has not been solved yet in any meaningful way. So it's like that combination of proven PMF, no final word on it, no design that solved it reliably or in a like optimal way, and the fact that it really does come down to how good are you as a designer and a tester, and how good is your team technically. I think like it is one of those things where, like I said, I love the culture. I love the sort of like the different communities and subcultures and the vibes of the crypto space. But I think designing and releasing a stablecoin that is just meaningfully better and gets closer to that sort of platonic ideal of decentralized stablecoin, which may never be reached, but every step is closer. Compared to other things like a new kind of DEX or like some new lending primitive or some NFT fi thing, a better stablecoin, it almost, how much better it is matters a lot more for its adoption than like how hyped it is or like who tweets about it or any of that stuff. Like that stuff is important initially, I guess, but a good stablecoin will just be successful. And it really comes down to how good is it, because it's a hard problem. But it's one of those problems where there's clear PMF, there's no good solution right now, and that's exactly the kind of space that I want to be designing in.
Right. I think that describes like the ethos for decentralized stablecoins in general pretty well. What about more specifically like for DYAD? Like what hole are you guys trying to fill in that space, like within the next year versus like in your long-term vision?
Yeah, for sure. So I think the number one thing holding back decentralized stablecoins right now is unit economics. And by unit economics, I literally mean how much does it cost? And I'm using cost as kind of this lump thing right now. I'm not talking about cost of the protocol or cost borrowers or whatever. Just like literally, what is the carrying cost on one of these stablecoins? So, like Liquidity, for example, I think Liquidity is, other than their dependence on oracles, which you could debate, is oracle dependence a bad thing? I'd say they are, if they somehow found some way to have non-oracle dependence and some endogenous price discovery of the ETH that backs them, they are the most pure stablecoin, right? Like they are completely immutable contracts. Only ETH is collateral, over collateralization, pretty conservative over collateralization requirement. And they deserve all the success that they've gotten recently. I think they're up to like 700 million TVL right now, which is really impressive for a stablecoin like that. The issue there, though, is their unit economics. It's hard, and I love the Liquidity team. Token Price is definitely like a friend and mentor in many ways with DYAD, and we're working with them as one of our launch partners. But it is tricky to drive constant demand for something like that, other than as a flight from less decentralized or just less robust stablecoin designs, because this over collateralization requirement, it will always cost more than $1 to issue an LUSD. And that's just a hard fact to get past. Whereas with like Circle and Tether, it costs them less than $1 to issue a USDC or USDT because they hold as collateral, barely over collateralized, these off chain, essentially zero risk fixed income assets. And they literally just keep the yield from it. So every time a circle or a tether is issued, USDC or USDT, that's a profitable event for those organizations. Whereas every time an LUSD is minted, that is an unprofitable event for the Liquidity protocol. And this is really the case with any CDP stablecoin. So and you can, newer designs like what's it called? Athena, which is based on, or not based on, but similar to UXD, which was on Solana, where you use a delta neutral position or some kind of perps based actively balanced position to back it. That's great as long as funding rates are going your way. Once they don't go your way, that position becomes expensive. You can keep rebalancing it, but it's just expensive to do so. Even in that case, if you start depending more on the LST yield to sort of fill that capital efficiency gap in an environment where funding rates are going against you, the yield from those LSTs are going to be probably riskier and maybe lower than you're planning. So it is at the end of the day a reflexive design that's not actually stablecoin like, and that it is exposed to things in the market or aspects of the market. The goal of DYAD and everything that we're building, the hole that we're looking to fill, and like this is a job we're doing, is maximize the unit economics of a stablecoin that is decentralized, uncensorable, immutable base layers, while
before we jump into how DYAD is going to do it, could you explain the USDC and USDT mechanism of how they make their money every time they issue?
Yeah, for sure. So when you can basically, and like this is
I can explain it like I'm 5.
No, this is kind of a spicy way to describe it, given the regulatory environment in the US. But they are essentially tokenized bank deposits, right? That's what those companies are. So you are as a depositor, you swap some ETH or just buy some USDC on Coinbase or whatever. Those funds go to Circle. They use it to buy some kind of treasuries or T-bills or whatever. Those are the backing collateral for Circle. If you have an agreement with Circle, you can redeem your USDC for that backing collateral. Basically, nobody really does that. I mean, some people do it, but retail doesn't do that. But as long as that collateral is there, they just keep the yield from it. So right now they're just keeping the 5.5% or whatever the yield is. That basically lowers their carry cost of this demand deposit, which means that they need to have $1 ready for any USDC that's out there. But if they're just keeping $1's worth and they're earning 5.5% on that, then yeah, that's less than $1 of carry cost that they have on that dollar liability that's out in the world. So that's basically that. I mean, it's a pretty simple business model. And you can see like Mountain Protocol, which you guys may have seen, but I think they're based in Argentina. It's basically that. It's Circle, but they only keep 5% of the yield, and then 95% of that yield on the fixed income backing collateral is just given back to holders of the stablecoin in the form of like rebasing, like very similar to like Lido. Which is an interesting product. It requires KYC and it's fully centralized, but it's an interesting flip on the USDC thing. But yeah, that's basically it. It's like if the collateral backing the stablecoin is yield-bearing collateral, and you don't really have to over collateralize that much because of you're centralized and you have complete control over the stuff that a decentralized stablecoin would rely on, like incentives and mechanism designed to achieve, you can very easily achieve a capital efficiency that is based on the fact that it costs you less to maintain these dollar-pegged stablecoins that can be redeemed at any point than the actual dollar peg. So you're basically turning a profit. You're creating something that's worth $1. It costs you less than $1 to create that thing.
I see. And from a high level, how exactly is DYAD going to be working? Is there an economic system behind that as well?
Yeah, so I'll start super high level. Basically, DYAD relies on competition between holders of DYAD NFTs, which we call notes. And these are just ERC 721 NFTs. People, you can mint them all, you can start claiming them already. DYAD stable.xyz. I think we're up to like 260 something have been claimed already, which is cool. But basically, you store as metadata your sort of share of the various collateral pools. The more aggressively you stake collateral, the more aggressively you liquidate other positions, and the more strategically you sort of look at the different pools, look at the level of competition there, deposit your collateral as needed, you can gain a right to mint your DYAD against a larger share of collateral in these pools than you actually put in. And that basically being able to mint against a larger basket of value than you brought into the protocol, that lowers your carry cost below often the $1 peg. So it's this competition, basically. Every DYAD that's in the outside of the protocol is over collateralized, and it is backed by more than $1 worth of exogenous collateral. It's just that the incentive is strongest for those NFT holders who've achieved the lowest mint cost or lowest carry cost on their DYAD to supply that DYAD to external strategies like we're doing with Blueberry, possibly Redacted and Yearn. That kind of pull, and the reason for that is like it costs you less than $1 basically to mint and carry your DYAD. Any yield you get on that DYAD externally, whether you're supplying it to a pool on a DEX or you're supplying it to a strategy that's looping it and doing something like Blueberry is doing, your yield on that will be multiplied basically by how much lower your cost is on that DYAD than the normal cost. So that means that the incentive for NFT holders is going to be strongest for those who have the lowest carry cost on their DYAD, which means the DYAD that makes it out of the protocol will be blended the lowest carry cost and the best unit economics. So unlike a protocol like Libra, where their incentive is maximize how much stablecoin every user of the protocol is minting as a way to minimize the amount of dormant exogenous collateral that's in the system. And that's literally a trade-off with the stability of the system, because they're incentivizing people to push their positions as close to the liquidation line as possible, which is kind of how you juice the most capital efficiency from a CDP design. But it's you're just trading that off against the stability and the resiliency of the protocol overall. Instead, we create this internal competition for the lowest carry cost. And really, we don't try to over-incentivize minting of the stablecoin. We don't try to over-incentivize debt in the system. We just kind of create this pull externally with yield opportunities and supplying to different collateral pools or different DEX liquidity pools for the NFTs that have kind of climbed that ladder to the highest point to be the first ones who are incentivized to provide that DYAD outside of the protocol. So the DYAD that does get supplied, depending on how good the yields are externally, is the DYAD that has the lowest blended carry cost on it. And again, I'm really excited to get into how we do that technically, but that's basically how we do it, like on a high level. It's just we have this competition. You compete by contributing and keeping collateral in the various pools. As you sort of climb the ladder, your DYAD carry cost gets lower and lower. But that said, you can turn a profit in the protocol just by flipping the NFTs. Like you don't have to mint a DYAD stablecoin at all. If you improve the secondary market value of your NFT, which is just lowering the DYAD carry cost, you can then flip that back on secondary to someone who does want to mint it, or another flipper who wants to bring it to another point. And so that economic activity essentially underwrites the possibility for the top NFTs to be able to mint their DYAD at a lower carry cost and still have those tokens over collateralized with collateral that's in the pools.
Okay. Could you go into that system, but with numeric examples? I log in, I have a certain amount of ETH, I click the claim the DNFT button. What happens, and what can I do? I think I have a good understanding based on that last explanation, but I just want to hone in on the exact process. And when you say carry costs, for people that aren't aware of that, could you explain that as well?
Yeah, carry costs can mean a bunch of things. It's kind of one of those general like finance terms, but in the form of like a stablecoin or DYAD, it's literally like, what is the continual opportunity cost at any point of maintaining a certain level of DYAD debt? So your DYAD debt is just your DYAD minted balance. How much DYAD have you minted, excuse me, through this given NFT? And if you burn DYAD that's in your wallet through a function in the contract, you can reduce that DYAD minted balance. But it's basically, what is the cost of maintaining that balance? And the more you advance in these pools, basically, or the more portion of these collateral pools you gain above what you actually deposited, the lower your carry cost on your existing DYAD debt and future DYAD debt becomes, because you're basically, that DYAD debt is written against both collateral that you did deposit and collateral that you did not deposit, that either other NFT holders deposited or came into the pools through the various fees. And then your DYAD debt gets a lower carry cost. So you can sort of think of it as like, I guess opportunity cost would be a good way to think about it. It's like, what else could you be doing with this collateral that's backing your DYAD? And if more and more of that collateral is not collateral that you yourself brought into the protocol, the portion of collateral you did bring into the protocol that's backing your DYAD debt gets to be lower and lower. And that's basically what we mean by carry cost. And that's kind of the main quest of the game, if you want to think about it that way. So let me walk you through, like, does that make sense? First of all, the explanation of like what carry cost means.
Yeah.
Okay. So let me walk you through basically what the process is like when you have, let's say you get your DYAD NFT. Now there's like a couple of different pools that you could deposit collateral to. So let's say there's like a wrapped ETH pool, a Lido pool, and a, I don't know, tokenized treasury pool, just to keep it simple. There are these three pools. So basically you look at what is the size of each of these pools and what are the quantity of other NFT holders who are participating in these pools, and what's sort of like the level of competition in there. And so the way that DYAD is structured, the way that it works, first let me start actually from the user perspective, and then we can get into like what's actually happening under the hood. So you would deposit, let's just say wrapped ETH, you deposit like 10 wrapped ETH into the wrapped ETH pool. You immediately to your NFT get metadata written that says you have this percentage. Let's say there's 1,000 wrapped ETH in the pool, you deposit 10 wrapped ETH. It says, okay, now you have this percentage of the wrapped ETH pool. The longer you keep that wrapped ETH in there, what's basically happening is your metadata points that represent your wrapped ETH in that pool. First of all, you can immediately mint DYAD against that. The contract is basically saying, okay, this is the current Oracle value of wrapped ETH. You have this percentage of the pool. We're basically using ERC4626 tokenized vault logic, just instead of the ERC20 share token, it's the metadata in your NFT. But you can mint DYAD directly against that share of that pool that you have right now. That collateral is not in your NFT, it's not in your wallet, it's in this shared pool, but your metadata in your NFT indicates you can mint against this slice of this shared pool. Now, the longer you keep it in there, the more share points you're earning. And it's this momentum-based staking mechanism where, if you want to think about, I'll use like a physics metaphor where it's like your amount of collateral that you put in, that's like the mass of this moving object. This object is accelerating at a constant rate. Every other NFT, their stakes and their objects, basically of various masses, depending on how much collateral they deposited, are all accelerating at the same rate. That's just this fixed reward rate that's just a hard-coded part of the protocol. Now, the more you accelerate, the more additional points or the more additional shares you earn per time unit that passes. So let's say you're 10 wrapped ETH. If you keep it in there for like a week, you will earn additional shares of this pool. Maybe it gets up to like 11 wrapped ETH or 12 wrapped ETH. That depends, though, on everybody else in this pool, because their shares are also accelerating, also growing. Everyone, like people who have the longest term shares because they get the longest time to accelerate, they'll get the highest reward rates. Now, when you add additional collateral to a pool, the new collateral doesn't just inherit your existing reward rate, because that would incentivize people to like put in a tiny amount, 0.001 ETH or whatever, allow the reward rate to accumulate with very little opportunity cost and then dump in like their 10, and it will just get to that high reward rate and start kind of maximizing the pool. When you add new collateral, the reward rate dips basically in the same way that like if you add mass to an already moving object, the speed will go down because it's more massive right now, and that new mass has zero momentum basically. But with a constant energy input, it will start to accelerate. It will accelerate at the same rate, regain the pre-add reward rate, and eventually surpass it. So this is our way of improving on basically the VE locking mechanism that's become so prevalent, where like Curve solidly you have like the 1 month to 4 year lockup. We're incentivizing the same thing, which is we want people to deposit a maximum size and keep for a maximum amount of time their collateral in these pools, because that's backing for everybody's DYAD debt basically. But we don't want to do the hard time locking because maybe people will do that with some like shitcoin governance token, but nobody's going to lock their wrapped ETH for 4 years. So this is our way of doing that, where we have the same incentive, but we don't require that locking. You can withdraw your stuff at any time. Now, the more reward
But
rate you
before you go,
accumulate in these, yeah,
yeah, just to clarify on the points,
yeah.
from my understanding, points are basically a representation of your share of the yield that you're getting from the pools, or that the collective is getting from the pools. Can
So
you
it's
explain
not,
what points are exactly?
yeah. So points are literally your quantity of points, and these are metadata points in a given pool, like let's say the wrapped ETH pool, versus the total quantity of points across all other NFTs in that pool determines the share of that pool that you can mint DYAD against. That's it. It's literally just like assigns a portion of the pool based on your points. Now, points are totally inflationary. The mechanism I just described, where when you have your points in this pool, they're essentially earning more points, as are everybody else's points in the pool. So the total quantity of points can go up and will go up, even if the amount of exogenous collateral, like the amount of wrapped ETH in the pool, is not going up. So it's inflationary, but that's okay because it's not like a token that you can like dump on a DEX or something. It's metadata of your NFT. So it's just a way of incentivizing this constant competition that is decoupled from like emitting a farm token, which, you know, we all know how that goes. It's basically that you could basically farm these points to earn a larger portion of the pool, even if the exogenous collateral is not going up. If it's not going up, it just becomes more PvP. If it is going up through fee inflow, through yield, like a lot of the pools will be these. So yeah, I mean, you're partially correct. Like our Lido vault and our other rebasing yield vaults, the greater reward rate you have and the more share of that pool you have, the more of that yield will flow into your collateral basket for sure. It's just the points are kind of constantly increasing. Your rate of point increase that you achieve entitles you to sort of more of the underlying collateral, if that makes sense. And then to withdraw collateral, you basically unstake your points and you burn them. And that allows you to withdraw a proportional amount of the collateral. But the higher your reward rate gets, like the more momentum you gain via this staking mechanism, the greater value destruction basically of withdrawing collateral. You can do it. We definitely don't lock you out of it, but like secondary will definitely pay a premium for NFTs that have these really high reward rates in the pools that people care about. Because again, it's a time-based sort of ramping up of how rapidly you're gaining more share of the pool or just more points in the pool. So you can kind of think of
If
like
the
there's
points,
two. Yeah, go ahead.
sorry, quick question. If that system determines how much DYAD you're able to mint, does it also have an effect on where you're liquidated, or is that solely based on the value of your collateral?
No, so okay, so let me describe the connection really quickly. So the value of your
Yep.
collateral, like what you're minting your DYAD against, that is the combination of your points defined share of each of these pools. So your basket of collateral as an NFT that you can mint your DYAD against, it's literally what is your share of points in pool A, pool B, pool C, multiplied by the USD value of all of the collateral in that pool. So let's say the total TVL of the wrapped ETH vault is 3 million, okay? And you have your points, you have 10% of the total points in that pool. That means that you can mint your DYAD against 10% of 3 million, 300K from that pool. And let's say you also have 1% of the points in the Lido pool, and the Lido pool has a 5 million TVL. That means you can mint against 50K. So now you have a total of 350K defined by your share of points in the wrapped ETH pool and in the Lido pool. You're minting your DYAD against that blended basket, basically, that's comprised of wrapped ETH and Lido. The debt is not specific to any one collateral pool. It's just cross-margined inherently across your points and all the pool, your shares of all the pools. So the reason you want to play this points game and you want to aggressively stake early and not unstake and ramp up your reward rate as much as possible versus the other NFTs is because that literally allows you to mint more DYAD, or another way of looking at it is it lowers your carry cost on the DYAD debt that you already have, or it makes the cost of minting new DYAD less because you have to put in a certain amount of collateral. If there's other collateral flowing in there, or even if there's not, if your reward rate is greater than other NFTs, basically, you're slowly encroaching on their collateral that they brought in. Normally, with the normal function of the protocol, there will be fee inflow into these pools as well. And so you're basically, and there is yield from the underlying collateral as sort of a third source. So it's going to be rare that you're actually like directly encroaching on collateral that other NFTs have brought in. It's mainly that you're fighting over these fees and the yield from the underlying collateral. So the more of that you can capture through this points accrual mechanism, the greater your basket grows beyond that which you put into it, and the lower your cost to mint DYAD becomes. And now let's talk about liquidation, because you did bring that up. So your minimum collateralization ratio is basically, well, first of all, a minimum collateralization ratio, all that means every stablecoin lending protocol basically has this. It's like, let's think about like your DYAD debt as the numerator in a fraction and the USD value of your collateral basket as the denominator. Let's say that the minimum collateralization ratio is 150%. That's pretty common. So that's like 2/3, right? Like for every 2 units of DYAD debt, you need 3 units of USD value. That's basically a simple way. So if your fraction of your NFT goes above that, where it's like you get to like, I don't know, 2.5 over 3 or whatever it is, 5 over 5/6 or something like that. If it's higher, if your DYAD debt exceeds that 150%, or really what would happen is you're not allowed to mint more DYAD than the minimum collateralization ratio. So it'd be like the value of some collateral in your basket goes down. And so now your DYAD debt is greater than that minimum collateralization ratio, you can be liquidated. And that's necessary for system stability. So the way minimum collateralization ratio is determined in DYAD is every vault, when it's onboarded, we can get into how we onboard new collaterals in a sec, but when it's onboarded, part of that onboarding is you define a minimum collateralization ratio specifically for that collateral type. So maybe for wrapped ETH, it's 150%. For some, like, I don't know, luxury watch wrapped in an NFT, super liquid long tail shit, it would be like 1500%. And maybe in the middle, it would be like 300% for some governance token in some other protocol, whatever. That assessment is completely up to the NFT holders. Will they accept or not accept some minimum collateralization ratio? You basically want it to be higher for less liquid, more long tail or more volatile collaterals, lower for more liquid, still can be volatile, but just like more established, less risky stuff like ETH, things like that. But basically your notes minimum collateralization ratio, like what is the limit against which after which will be liquidated, is the weighted average of all of those collateral types that comprise its basket. So the weighting, it's just an average of all their minimum collateralization ratios that are specific to the collateral types. And the weighing of that is what portion of your basket in USD terms does this collateral comprise. So let's say you have 80% wrapped ETH, 20% NFT wrapped luxury watches, okay? And so it's like 150%, 1500%. If 80% of that is wrapped ETH and 20% is the watches, maybe your minimum collateralization ratio is like 300 something, because it's mainly the 150% and then a little bit of that 1500% pulling it up. If it's 20% wrapped ETH, 80% watches, then your minimum collateralization ratio might be like 1200% or 1300%. So that means you need a lot more USD value, because most of it is this illiquid, risky stuff, to mint the same amount of DYAD. So that's basically how we do it. There's no like protocol wide minimum collateralization ratio. But basically, yeah, given that logic, the more collateral you get into your collateral basket via this momentum like points mechanism, the lower your cost to mint the DYAD, because you're basically minting it against collateral you did not bring into the protocol. So that's essentially the core like game logic of DYAD.
Does that almost incentivize like almost DYAD NFT holders working together in a way to like, wouldn't people would be prioritizing collateral that has lower MCR requirements in order to like bring the entire pool down and allow cheaper DYAD minting costs? Or is it more so like, because it's the way you described the point system to start out, it sounded like it was more so like you need to be, given the inflationary nature of the points, you need to be consistently adding to your collateral, staking early and staking often, in order to not have your share diluted. But it kind of sounds like with how liquidations work and how the MCR is more holistic than it is like on a per account, per asset basis. It sounds like it almost incentivizes teamwork a little bit in a ways. Is that accurate?
Yeah, I mean, I want to be totally clear. There are definitely elements of cooperation, and it really gets to that when we talk about like answering the win token question, which I'm happy to answer later on. It's kind of a slightly separate discussion. In the pools, it is generally competitive. I think that there could definitely be situations where a single user controls multiple NFTs, and that's actually, there's a lot of benefits to that. Like when a single NFT, as it starts to control more and more a larger portion of the pool's total points, its points accrual rate or its reward rate starts to go down substantially, as sort of a leveling mechanism. But no, to your question, like where does cooperation come in? To be totally clear, the MCR for a given pool, that's set at the time when the pool is on board, and that can't be changed once it becomes part of the sort of DYAD pool system, unless it's offboarded, which we have a very simple process for that, and then onboarded again with like a different proposed MCR. The MCR of each individual NFT is unique because each NFT has a unique composition or mix of the different collateral from the different pools comprising their own basket. And the MCR is just derived from what is the average of the MCRs in each of those pools, weighed by the portion that pool comprises of the NFT's individual basket. So it's not so much like they can work together to lower the MCR of a given pool. That's fixed. An NFT holder can definitely make the judgment call, like, do I want to focus on just building my basket and building up my points in the lowest MCR pools, or those pools that are like the most liquid, least volatile, or do I want to go for some of the potentially much higher yielding but higher MCR, less liquid collateral types? The reason we have that MCR is it's, banks use a really similar mechanism where it's like, for a given type of collateral, depending on how liquid it is, if it's like treasuries, you only need a certain amount of backing for the amount of deposits you have. If it's like real estate, you need a lot more, because if you need to sell it, you just can't sell it. It's not, I mean, that's literally liquidity. Like, how much will selling it impact the price in the market, and how ready are buyers to just take it off your hands? You just need more of it. So that's basically what we're doing with this kind of variable or discrete MCR per collateral type system.
So just to clarify,
Yeah.
across the board, there isn't a set number, but today, what does that MCR look like today across some of the pools?
Yeah, so we're gonna start probably with like, I mean, there are no pools right now. DYAD is we've only deployed the NFT contract, so you can claim an NFT, but we are still in audits, and we're doing a lot of audits and a lot of like testnet and security stuff for the vaults. Definitely do not want any forced migrations or any of that stuff out the gate. So we're just moving very carefully, taking as much time as we need in order to get that right and to not be exploited when TVLs start to go up. But yeah, so I think for the very liquid collaterals, wrapped ETH, I'd include Lido in that. Sort of the things that just are highly liquid and don't really have that liquidity risk attached to them. It's going to be probably around 150% to 200, and that's just kind of a best practice across most over collateralized stablecoins. With the less liquid stuff, and we're not really starting with any of that, but we are working with like Venture Club that does NFT wrapped venture equity. We're working with watches.io, which is sort of the luxury watch example I gave. 4K does that, and Backed Finance, which does sort of institutional real world asset stuff. I'm not like crazy bullish RWAs right now. I think it's an interesting narrative. It's more just making sure that DYAD is robust enough to absorb very challenging collaterals like that. Those will have higher MCRs. And if you may build your collateral pool with those, it will just increase your overall MCR that you can make your DYAD against, and really defines when you get liquidated as an NFT holder.
And how does that scale? I'd say like most of the issues with decentralized stablecoins come from the scalability issues. How does DYAD scale? If you don't think it necessarily needs to, why not?
Well, no, DYAD absolutely needs to scale. Scalability is like a critical part of any stablecoin design. Really, the reason DYAD can scale, so mostly scalability is a unit economics question. Like, it's, can you continue to drive demand for this thing beyond a certain size? And that's really where a lot of the decentralized stablecoins hit this ceiling, right? Like, I don't think Maker's gotten above 5% stablecoin market cap at any point in time. So yeah, I'd say like the scalability is, I started this off talking about unit economics in a way that is the prime thing that we're solving for. And again, it scales because this ongoing competition, there gets to be this flywheel. And I really, as a mechanical engineer, I really hate that term, because a flywheel is literally a physical inductor. It's not what perpetual motion machine, the way that it's used in DeFi and in business and tech. But I'll use the term because it's what is understood it to mean. But basically, the DYAD sort of becomes this liquidity magnet, and this is actually a good time to dive into the token, because the token is a key part of this. So basically, if it hasn't seemed complex enough already, well, before we get into the token, is there any part of the core mechanism that I just described? Let me quickly describe liquidation, because that's important to understand in the context of all this, and then you'll have like a full picture of how like the system that we're launching and NFT holders will be using works. So with liquidation and DYAD, because the collateral is in these pools and it's never in an individual NFT, it's never self-custodied by people's wallets or anything. When a liquidation happens, no collateral is sold. There's no auctioning of it. It just stays in the pools. Nothing happens to it. It's not even moved. That's very different from pretty much every other lending or stablecoin protocol, where when a position is liquidated, that collateral needs to be sold immediately in order to incentivize liquidation, pretty much. What happens in DYAD, because we have this point system and it's stored as metadata, when an NFT gets liquidated, which just means its DYAD that exceeds the minimum collateralization ratio it has versus the value of its collateral, any other NFT can trigger that liquidation, and they absorb all of that liquidated NFT's DYAD debt, and that's taken into their metadata, added to their DYAD minted balance. And they also absorb all of their points in all of the pools. And remember, points just entitle you to a share of those pools. So what's really cool about this, and what speaks to sort of the safely inflationary nature of the point system, we put a bonus on the quantity of points that the liquidator absorbs based on how underwater the liquidated NFT was at the time of liquidation. So let's go back to this example of the NFT that had 80% of its collateral in this long tail illiquid collateral type that, let's say, that goes to zero. So this NFT is way underwater, has way more DYAD mint balance than it does value in its collateral basket. What we basically do is we multiply its points in every pool, both the pool that's now worthless, but also the 20% in pools that still have value. Maybe it has like that in wrapped ETH or Lido or whatever. And the liquidator captures that in sort of exchange for taking on all of their debt. What happens in that case is the quantity of points in these pools that, you know, the liquidated NFT had points in are expanded. So the other NFTs are essentially diluted in these pools to make room for the liquidator to incentivize that liquidation of a super underwater position. And then the higher your reward rate basically in these pools is one of the other NFTs, the less you'll be exposed to that dilution from the liquidation. So that's sort of our like fallback emergency system in catastrophic scenarios where backing collateral is like going to zero, basically. The system socializes through this points-based dilution that incentive to liquidate and to take on that unbacked DYAD debt, basically, in a very granular, sort of elegant way, where you're not just spreading the socialized debt across everybody or even spreading it pro rata based on some metric. It's literally which pools are you in, what's your reward rate that you've achieved in those pools through staking. That determines basically how exposed you are to the dilution from the liquidation. But again, most liquidations will execute totally in the realm of metadata without needing to dilute or boost the quantity of points because of the minimum collateralization ratio, as we said.
Gotcha. Okay. And then I think you mentioned that that's a good segue into the token as well. I know you guys have some
for
good
sure
information on that. And then I don't know. Well, I want to ask about governance as well, but I guess I'll leave that for a second question because I think that's definitely important for a system like this.
Totally. So let's get into the win token question. So this is where it gets to be like what I've described is fairly competitive between NFTs. It gets to be PvP in cases where there's not a net inflow of exogenous collateral to the pools. And it's still kind of PvP because you'd be fighting over like yield and fee inflow into the pools anyway. This is where it gets kind of cooperative. So over the first month, basically, we are going to be keeping tabs on what is every NFT's average of DYAD minted balance, or like how much DYAD stablecoin are they carrying, have they minted, and do they carry, without redeeming it over the course of that month. We are going to then just drop this token based on that and that alone. So obviously we want to incentivize the minting of DYAD and supplying it to LPs and to the strategies externally. But really we're just looking at that one metric. So you get this token, it's just a volatile ERC20. There's a hard cap of 1 billion. And then you as a NFT holder can choose to stake this token to as much as you want to any of the pools that are currently part of DYAD. And when you stake it to the pools, to be really clear, the token does not count as collateral in these pools. The pool would still have its exogenous collateral. You're just staking it to these pools to basically direct this bonus that the pools imbue via the points that NFTs have in the pools to the points accrual rate and all the other pools. So the way that this basically works is the more portion of this token that a pool has staked to it. Let's say the wrapped ETH pool has 40% of the 1 billion tokens staked to it. That means that every NFT that has points or has a share of that wrapped ETH pool gets a bonus to their accrual rate, which, remember, normally you just build this rate by staking for a long period of time, and it ramps up, and you add new collateral, it dips momentarily and then comes back, sort of like mimicking momentum as an alternative to the time locking. Depending on what portion of this token the pools have staked to them, you as an NFT holder, your points in those pools entitle you to an additional bonus to your accrual rate. And that bonus is proportional to the portion of points that you have in that pool. So it's this double proportionality, but the proportion based on the points that the tokens that you stake to the pool is applied to all NFTs with points there. So let's say that you get, I don't know, 1,000 of these tokens, you stake them all to the wrapped ETH pool. That will improve your accrual rate in every other pool based on how many points you have in that wrapped ETH pool, but it will have the same effect on every other NFT that has points in that wrapped ETH pool. So the staking of the tokens has this universal effect for all NFTs that are staked there. What this basically does is for each NFT, it gives what we call the individual global bonus. And that's just what is the bonus across all the pools where you have points based on your portion of points in those pools and the quantity or the portion of the token that those pools have had staked to them. But this creates like a really interesting system where for other protocols, like for example, we're working with Redacted, they're making a pool around their ETH, PXETH LP token. PXETH is their LST that's coming up that I'm really excited about. That's kind of based on their own. It's basically an LST based on the value of block spaces, based on their own decentralized, like the Dinero system that they're building. What's the exact name that they're using for it? Anyway, that's not important. Basically, they can incentivize buy pressure or liquidity on their ETH, PXETH, LP token, which is the underlying collateral in this pool, by accruing this DYAD token that we're probably going to call kerosene. We don't know exactly what we're naming it yet. By accruing it, having it staked to their pool, so that the points that you get for depositing and keeping this ETH, PXETH, LP token in this pool improve the secondary market value of your NFT and improve your accrual rate in every other pool, because the points in that pool are sort of powered by the portion of the tokens that are staked there. So this is like a development, obviously, of like the gauge system that Curve originated, done in just a more fluid and more, I would say, dynamic way. But this is where NFT holders start to work together, right? It's like NFT holders will be incentivized to get the most tokens staked to the pools where they have the greatest share in their collateral basket, or they have the most portion of points, because that improves their accrual rate in all the other pools and thus improves the secondary market value of their NFT. At the same time, projects that are using DYAD to drive liquidity to their token or to their LP pairs will obviously want to accrue this token, get it staked to those pools, so NFT holders are incentivized, whether they're aware of the project or not, to buy the LP token or the token that's underlying it, deposit it in the pool and keep it there and add to it in order to accrue the most points there. So that sort of completes the flywheel, if you want to call it that. But the entire DYAD system, where it becomes a place to, it's definitely not a DEX. We're not doing any swaps, but it's an alternative or an adjunct to a DEX if you're using it on an LP token, to bootstrap liquidity or drive liquidity to your token or LP pair, essentially through metadata, and not having to leak not having to literally pay for it, other than accruing the token on the open market once it starts to trade on secondary.
Interesting. Okay. Yeah, I'm a big fan of that, like that whole approach that Curve has kind of coined, and applying it to different systems. I think we're starting to see more of that nowadays, especially. You mentioned like earlier on, given your background in hardware, and how you didn't really like vibe with the whole move fast and break things kind of movement. Um, I'm wondering if like you're kind of taking a similar approach to governance. Like it sounds like, based off of your background, you might be more interested in like, getting things right the first time around, building a very like anti-fragile system, and then making it as governance minimized as possible. Would that be an accurate assumption?
Absolutely would be an accurate assumption. So there's kind of this governance conundrum where something like Liquidity, which is completely governance free, they are coming up with Liquidity V2 right now, right? Because it's so limiting to only have ETH as backing collateral, and it opened the door to these Liquidity forks, and they're definitely not at the level of quality as Liquidity, like not even close, but like Libra, Prisma, Raft, all of these, that literally just substitute LSTs or some other collateral for ETH, right? And the fact that there's no governance mechanism, it is very pure, but it sort of leaves the door open for that kind of thing. So really all governance should do in a stablecoin protocol is onboard new collateral, or possibly with a very high bar to cross, upgrade certain parts of the logic. At the end of the day, you sort of have to think of like what ultimately secures even a blockchain is social consensus. And that just means that validators can decide to really do anything. There just have to be incentives that incentivize them not to destroy the blockchain, right? Because there's value locked in that. But there's really like at the bottom of anything, there is a level of social consensus if that thing is going to be in any way adaptable to the external world. Now, governance, traditional governance, generally tries to do two jobs in one, and it doesn't do either of them very well. The two jobs being allowing the protocol or the organization or whatever to adapt to changes in the outside world, and the other one be to create this sense of agency and engagement with the community. By binding those two together, you get these really skeuomorphic, like democracy-like systems that sort of, yeah, they're just kind of skeuomorphic with like off-chain government-style democracy with votes and proposals and all this drama and forums and everything. And that's clearly suboptimal. Like we don't have to mimic that. We have new tools at our disposal. So the way governance works in DYAD is every NFT, basically for every new collateral type that is proposed, has, the best way to think about it is like an on-off switch. And there's one per NFT. And for each collateral type that's proposed, the NFT gets to flip their switch on or off. And they can change the position of their switch at any time. So there's no like vote date where a decision has to be made, and after that, it's just made. It's just any collateral type that gets a 2/3 supermajority of the switches flipped on can now be DYAD collateral and has a pool and can be used in the system. It can lose that at any time. If NFTs start to decide to flip off their switches for whatever reason, and it loses a 2/3 supermajority, DYAD can no longer be minted against it. It can be redeemed against, but you can't issue new debt against it. So yeah, this is basically the way that our governance system works. It's asynchronous, it's atomic, and it's specifically designed to not open the door to like high stakes vote days and drama and delegations and all this kind of stuff. It can also be used, which is really cool, to onboard completely new logic. So the way that we're starting all these pools I'm mentioning, there is a vault design that's the thing that we're auditing right now, that's going to be the point system, that's going to be all of this mechanism I just described. You can, through this licensing layer is what we call it, or this on-off voting layer, which is an immutable layer below that vault design, you can actually onboard completely new vault logic. So if we come up with, or some other team comes up with a version of the vault that doesn't use oracles, it uses some kind of endogenous price discovery, or that is based on some kind of like super illiquid collateral, some new kind of NFT or something, basically that 2/3 supermajority gives any contract the right to mint DYAD. That's ultimately what it controls. And the 2/3 is a really, really high bar, especially once there are more NFTs claimed and once the community is not just all hanging out on our Discord. It will be harder and harder by design to onboard new things and to change things. It just raises the bar basically of how compelling or how much better the thing needs to be as the protocol grows, as the TVL gets higher and higher, which just is sort of this, that is ultimately the security, because if you could get 2/3, you could onboard like some contract that you create that just allows you to print infinite DYAD with no backing collateral. You could do that through this 2/3 system. Early on, when it's easier, cheaper to gain control of 2/3, there will be less to gain from that because there'll be less TVL. As the protocol grows, that 2/3 will get to be a more and more expensive thing to attack, because there'll just be more NFTs and the price of acquiring them will be higher. So that's basically how our governance works. In a way, it controls everything, but it's a very high bar to make any changes. And it's just totally asynchronous.
Okay. Yeah. Yeah, I think that makes a lot of sense. I mean, onboarding new collateral is really like, at least as far as we've seen, is far and away the most important thing to be cognizant of when designing something like this. I also think it's really interesting how like you can kind of see bits and pieces in dyad where like it's clear your background in like the hardware world and the mechanical world kind of comes through and has found its way into different design principles there. When reading through like some of your stuff, it's I mean some of it's obviously a lot easier to spot than others, like with the point system specifically. But that's always something I've found to be interesting. I know we're quite a bit over here, so we're going to start to wrap up. But we want to give you a second in case there's anything you want to tell the audience, anything we might have missed that you want to talk about, any calls to action you might have. Now would be a good time for that.
Yeah, I would say for anybody interested in DYAD, now would be a good time to, if you want to get exposure to the system, you want to be able to participate in it. Now would be a good time to claim one of the NFTs. Again, just DYAD Stable to XYZ. Simply because we use, there's no limit to the total quantity, but we use a simple linear bonding curve. It started basically, I don't know, 0.01 something ETH. Now it's up to 0.367, I believe. So we're still pre-launch. By design, as we launch and there's more kind of proven value to these NFTs that you can look at on chain and see like what the upside is, that will probably start to increase fairly substantially, and the limit to the quantity will be the price on this bonding curve. So yeah, I would say that would be the number one call to action if you're interested in getting exposure, being able to participate in DYAD. That would be the place to start. Yeah, and I'd say also to any other projects that this sounds interesting to, as I said, we're actively working with Redacted, Liquidity, Mountain Protocol, Blueberry, some really excellent partners. But always interested to talk to other projects that either want to use a maximally efficient, resilient stablecoin in some kind of a strat or something that they're building, or want to drive buy pressure to their token or LP without actually needing to leak their own liquidity to incentivize that. Definitely interested in talking. So yeah, hit me up if that describes you.
Awesome. Yeah, I'm sure there's some people in our audience who would fall into one of those buckets. Yeah, I think that's a good spot for us to stop here. Definitely a lot we got into here, a lot to still get into on on my own end as well, just to familiarize myself a bit more. But really appreciate you coming on. Very, very fascinating stuff. Definitely looking forward to seeing how this stuff performs as more NFT holders come in, more collateral gets put into the system, more collateral gets onboarded, markets turn around eventually as well. And yeah, just thanks for this great stuff.
Yeah, Ali, Cedo, thank you very much for this time. Thanks for getting me talking about Ozma a little bit at the beginning. And I know that this is, to talk about this all in like an hour and 15 minutes, it's like a pretty heavy information dump. So anyone who's listening who actually wants to see the docs, you guys can just share the link if you want to on Twitter, if that's easiest. They're basically public at this point. You're also welcome to reach out to me. My DM's always open, just at Joey Roth on Twitter. Yeah, I'm happy to get into any of these points with anybody who saw this and is like interested, but it's just a lot of information all at once and wants to understand in a bit more depth and get a sense of how the whole system works together. Always looking forward to those conversations with people.
Awesome. That's episode 40. Appreciate you, Joey, and appreciate everyone who watched.
Thank you so much for having me. Yeah, I really appreciate it. I hope it was fun. All right. Talk to you soon, guys.
Yep.